Sime Darby is buying a 61.18% equity interest in UMW Holdings from its parent Permodalan Nasional for RM5 per share in a deal worth 3.57 billion ringgit. The biggest automotive deal in the country will see Sime Darby launch a mandatory general offer to buy the remaining shareholding of 38.82% and take UMW private. The MGO is expected to roughly cost 2.27 billion and values UMW at 5.84 billion ringgit. Sime Darby's Group CEO Datuk Jeffrey Salim Davidson explains that this will give it a full presence across the spectrum by adding high-quality mass-market car brands to its automotive portfolio. He points out that Sime Darby is largely a retailer and that the UMW takeover would help it to plug the gap as Perodua and Toyota are largely in manufacturing and distribution. It is worth noting that UMW is one of the largest automotive and industrial groups in the country, with strategic partnerships with global companies such as Toyota Motor Corp and Komatsu. It also owns a 38% stake in Perusahaan Otomobil Kedua or Perodua. As such, Jeffrey expects the acquisition of UMW to open up more opportunities for Sime Darby's automotive segment in Malaysia and other international markets. Group CFO Mustamir Mohammed says that Sime Darby will absorb UMW's debts totaling 2.7 billion ringgit. It intends to pare down UMW's borrowings by selling its stake in the healthcare JV that it has with RM3 Healthcare, as well as selling a parcel of land it owns in Labu Seremban. Jeffrey said that the group has yet to discuss with UMW on its future plans, as it is still early days, dubbing the acquisition as an engagement ceremony between the two parties. Meanwhile, Sime Darby saw its net profit for FY 2023 improve by 32% year-on-year to 1.46 billion as its fourth quarter earnings doubled. Revenue for FY 2023 rose 14% year-on-year to 4.83 billion from the 42.5 billion posted previously. The group also declared a total dividend payout of 13 cents per share compared with 11.5 cents per share in FY 2022. Kuala Lumpur Kepong has proposed to buy 739.2 million shares or 33% and one share in Boustead Plantations for a total of 1.15 billion or RM1.55 per share, valuing B-Plant at 3.47 billion ringgit. KLK also plans to take the company private via a mandatory general offer, confirming the Edge's report. KLK entered into the tripartite strategic collaboration agreement with Boustead Holdings and Lembaga Tambung Angkatan Tentera on August 24th, the group said in a BOS filing. Boustead holds a 57.42% stake in B-Plant, while LTAT holds a 10.59% stake in the planter. At RM1.55, the offer is at a 90% premium to B-Plant's net tangible asset of RM1.30 and 13% premium to its last trading price of RM1.37. The group said the objective of the SCA is to work together with Boustead and LTAT towards the long-term objective of enhancing the operational efficiencies and CPO yields of the plantations of B-Plant over the long term. LTAT CEO Dato' Ahmad Nazim Abdul Rahman called the strategic collaboration timely, adding that it marks the beginning of the reset strategy for Boustead, which will result in a significant value enhancement to the group. KLK CEO Tan Sri Lee Ui Hian said the planter is optimistic that this corporate exercise will bring positive benefit for Malaysia's palm oil industry as a whole. KLK plans to fund the exercise via a combination of bank borrowings and internally generated funds, and barring any unforeseen circumstances is aiming to complete the acquisition by the fourth quarter of 2023. Meanwhile, the two planters also reported quarterly earnings today, where both saw softer numbers broadly due to lower CPO prices. KLK saw its third quarter earnings plunge 85% to 84.1 million from 558.3 million as revenue declined by 27% year-on-year to 5.1 billion ringgit. B-Plant slipped into the red for its second quarter, posting a net loss of 5.5 million compared to a net profit of 73.2 million the year before, as revenue fell by 42% year-on-year to 201.2 million for the quarter under review. The prosecution in Datin Sri Rosmah Mansur's second criminal trial, where she is facing 17 charges of money laundering and tax evasion, told the High Court today that she has no independent source of income, yet had large sums of money deposited into her current account that she has in Affin Bank. Deputy Public Prosecutor Ahmad Akram Garib said Rosmah was not gainfully employed, but the prosecution noticed that the monies were deposited through Roslan Sohari, who was at the time the residential house manager of Sri Perdana Complex in Putrajaya. Akram said the first 12 charges concerning money laundering pertain to deposits to this account, and they were never disclosed as revenue and were deposited and utilised by her. The DPP said Rosmah had made false statements concerning the monies paid into her account when she was questioned by Malaysian Anti-Corruption Commission officers. The prosecution also stated that the totality of the evidence, when considered as a whole, supports the irresistible inference that the deposits in question were proceeds of unlawful activity. During the trial, a witness told the court that he had deposited an envelope of cash totaling 200,000 ringgit into Rosmah's account in June 2015. Faisal Shamsuddin, who was the prosecution's second witness, said he was not aware that the envelope contained cash until the bank officer had opened the envelope. Faisal once served as operation manager in the Operations Management Department of the Sri Perdana Complex, while Rosmah's husband, Datuk Sri Najib Razak, was still the PM. Genting Malaysia returned to the black in the second quarter, posting a net profit of 47.12 million compared with a net loss of 10.85 million a year ago, boosted mainly by a 182.2 million net gain on disposal. It should be noted that since January 2022, Genting Malaysia has been in the red for 4 out of 6 quarters. Revenue grew by 14% year-on-year to 2.47 billion, driven by the increase in volume of business by Resorts World Genting and higher contribution from Resorts World New York and the improved operating performance of Resorts World Bimini. Genting Malaysia declared an interim single-tier dividend of 6 cents per share. For the first half, Genting Malaysia recorded 19.7 million net profit versus 137.4 million net loss a year earlier, as revenue grew 22% year-on-year to 4.76 billion from 3.9 billion ringgit. On its outlook, Genting Malaysia said it will leverage its integrated resorts offerings to capitalise on the increasing inbound tourist arrivals to Malaysia to drive incremental foreign visitation to RWG and continue to invest in the infrastructure at Genting Highlands to elevate customer experience. In the US, Genting Malaysia says it remains focused on strengthening its leading position in the New York State gaming market and continue to closely monitor developments surrounding the New York Gaming Board Facility Board's request for application to solicit proposals for up to 3 commercial casinos. DRB-Hicom saw its second quarter earnings plunge 80% to 33.7 million due to the absence of asset disposal gains recorded in the previous year's corresponding period. In contrast, revenue increased 12% year-on-year from 3.55 billion to 3.98 billion, driven by its automotive segment, mainly with contributions from Proton, automotive distribution companies, and manufacturing and engineering companies. For the first half, net profit dipped by 1.5% to 141.6 million, as revenue improved by 22% to 8.09 billion from the 6.62 billion posted last year. Proton recorded a 28.6% increase in sales volume, with the Saga, X50 and Persona contributing more than 80% of the national car maker's total sales volume. Meanwhile, the banking sector recorded a 37.3% increase in revenue in the first half to 806.8 million, primarily due to higher financing income led by growth in financing volume. DRB-Hicom said its postal sector remains on track in its transformation roadmap, leveraging on technology to enhance customer experience and continue to adopt prudent cost control discipline. The conglomerate expects a satisfactory financial performance for FY 2023 compared with the previous year.